On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Right, morning everybody. Thanks for joining me again. I wanted to talk today about fixed income. I actually had someone write in, a listener or a reader, write in and say, look, we're always talking about shares. You talk about them a lot. You write about them a lot. We hear a lot about the share market. We don't hear much about bonds or fixed income, and many of us out here in investor land don't understand bonds or fixed income as well as we should. So could you talk a little bit more about that side of the investment fence, so to speak? And I thought that's a fair point, actually, because we do talk a lot about shares and houses and property, whether it's people like myself, whether it's the business media. All the attention seems to be on what's the share market doing, what's the housing market doing. We talk about interest rates, but we don't talk about fixed income very often, which is wrong actually, because fixed income is a very large asset class and it does belong in those mainstream discussions more than it should be. And it's quite good timing, actually, because I have been thinking a little bit about fixed income with interest rates where they are and just pondering where they might go, where the economy might go, what the Reserve Bank and the Federal Reserve and other central banks around the world might do next and over the next 6 months. It has been on my mind that fixed income, in my opinion, is starting to look quite interesting. So, good chance to talk about it. It is quite important to many investors. I had a look on the Reserve Bank website where they detail the amount of KiwiSaver assets and how those are spread across the different asset classes. And if my calculations are correct, fixed income is almost 50% of our total KiwiSaver assets. And that's a lot, actually. And if we think about your typical investor, your typical diversified portfolio, someone that's sort of balanced or someone that does have a diversified approach to investing, fixed income is often anywhere between 20 and 40% of such a portfolio. Obviously, if you're a younger person with a high tolerance for risk and 50 years of investing ahead of you, you might not have any fixed income. You'll be all shares, all property, all private markets, all the exciting stuff, and that's fine. But for other people that have a more middle of the road balanced approach, or those that just have a slightly more conservative tolerance for risk, or maybe if they need income, then they probably do have a fair whack of bonds or fixed income. And those terms are somewhat interchangeable. So when I'm talking about fixed income or bonds, basically talking about the same thing. We finance people have a bad habit of chopping and changing. In the same way we talk about shares or stocks or equities, all the same thing, really, just terminology. And fixed income is probably the proper name, but we often just say bonds because it's sort of easier. Stocks and bonds. That's kind of what we boil things down to. But anyway, what is fixed income? What are bonds? Fixed income really does encompass everything from government debt, local authority debt, through to corporate bonds, which ones, corporates, just companies, and even term deposits. Your bank term deposits. I would say that anything with a maturity of more than 90 days, more than 3 months, that is fixed income as well. Anything less than 90 days, you'd sort of call that cash. So when it comes to those conservative assets, you really are drawing the line between what's sort of cash or what's very liquid in terms of deposits, and what is longer term, and that sort of makes it fixed income. So when you're investing in fixed income, when you're buying a bond, when you're buying government debt, you're becoming a lender to that entity. So whether it's a bank or a company or a government, if you buy a government bond, you're lending money to the government. If you buy a fixed income security that's issued by, one of our big corporates, you're lending them money. So that's essentially what's happening. You're giving them that capital to use for a period. Maybe it's 2 years, 5 years, 7 years, whatever it is. At the end of that time, they will give you your money back, or in theory, they'll give it back to you. And along the way, you'll be paid an interest rate or a coupon. So you're on the other side of the fence as if you're a borrower going to the bank asking for a mortgage. Can you lend me this money? I'm going to use it to buy a house. I'll pay you an interest rate, Mrs. Bank Manager, along the way, and then you'll get your money back at the end of the period. Different situation, obviously, because you pay that sort of principal along the way. But essentially, using fixed income or buying fixed income or investing in fixed income, you're a lender to that company in question. So you have to put the hat on of a lender or of a bank manager and think about how safe and creditworthy and reliable is this entity that I'm lending money to? Will they be able to pay me back? How safe are they? Am I getting a high enough interest rate to compensate me for the type of risk I've taken on by lending them money? Think of your group of friends, and if 4 or 5 of them all individually asked if they could sort of borrow 100 grand for 5 years, there's probably a couple of mates that you'd offer a slightly higher risk interest rate than others, isn't there? Because not everyone or not every entity is the same sort of reliability level or credit risk level. That's maybe that's an unfair analogy, but it probably is reasonably appropriate. Anyway, governments and local authorities tend to be the safest entities because the government can just put up taxes, the council can just put up rates, so they kind of have an easier path to increasing their revenues than many others. So because of that, they tend to be safer. They offer the lowest interest rates. So in New Zealand, you'll get a much lower interest rate on government debt than corporate debt. Corporate bonds obviously slightly riskier because that rather than that being a government or a council that can just put up rates, put up taxes whenever they feel like it. Corporate bonds and the ability of that company to pay back their debt is really quite dependent on the health of that business. Are they succeeding? Do they still have customers? Are they still turning a profit? Companies can get into trouble, so you've got to think very carefully about who you're lending that money to. Who's on the other side of this transaction, and when it comes to fixed income, getting your money back is paramount. They say the return of your capital is much more important than the return on your capital. And what they mean by that is, don't chase the highest interest rate if it means putting your capital at risk. You're much better to play it safe. I always think fixed income bonds, that's your bedrock, that's your cornerstone, that's your safe stuff. It's where you want to have the lowest level of risk and the most certainty. Take your risks in shares or private businesses or even property and real estate. That's where you take your risks because you get paid for them. In fixed income, it really does make sense to be more conservative and play it safer. So the general rule is that anything that sounds or looks too good to be true probably is. And driving this morning in the car, and I heard a radio ad for some organisation that shall remain nameless advertising some security that will pay I forget if it was a 8, 9, 10% sort of rate. And you've just got to be a bit wary when you hear or read those sorts of returns, because when you've got an OCR of 5.5, and you think about where government bonds are at, you think about where good quality fixed income yields are, anything that's offering you 9 or 10 is probably quite risky. So think very carefully about what you're doing with your money when it comes to fixed income. If it sounds too good to be true, it probably is. And if in any doubt at all, talk to an investment advisor. I've seen so many people get burnt taking risks that they shouldn't have in fixed income back in the GFC with the finance companies, and it's still a minefield. So you still need to get good advice. But if used wisely, fixed income can be fantastic and a really good asset class for people. It won't give you that long-term growth you'll get with shares or real estate or private businesses, farms or anything like that, but it does provide regular, predictable income and stability during uncertain periods. So if you are of a conservative nature, if your investment time horizon is, say 10 years or less, if you need income, if you don't like the ups and downs of property markets and share markets, then fixed income can be really useful to have as part of your portfolio. Having said that, prices can still fall. Fixed income values can still go down. Doesn't happen very often. We saw that in 2021. We saw that in 2022. And I think those were the first 2 years that we'd seen negative returns from fixed income since the 1990s, at least in terms of corporate bonds. So it's very rare that fixed income prices will fall, but it can happen. And that didn't happen in 2021 and 22 because governments or companies defaulted on their debts. It wasn't because someone got into a position where they couldn't pay investors back. And even though those valuations of some of those securities over that period fell, the investors in those securities, they will still get back all their money upon maturity. But a lot of these securities trade on the open market, just like shares. So, there's people buying and selling them every day. And that means the prices can move around. And lots of things can make the prices move around, but the prevailing market interest rate is one of the biggest drivers of what prices will do. So when market interest rates are going up, the price of existing bonds tends to fall. If you say you invested in a bond or a term deposit or a security of that nature, and you got a 2% interest rate, and then in a year's time, interest rates had moved higher. They'd gone up to sort of 5% from wherever they were. People wouldn't want to buy your 2% yielding bond for the same price. It wouldn't look quite as attractive to potential buyers because they can get a higher rate in the current market. So your bond from last year or the year before, which still exists and is paying that sort of, locked in interest rate, will fall in value. And that's what happened. That's basically what's been happening since the pandemic, because during the pandemic, interest rates everywhere in the world fell to very low levels, pretty much zero, and bonds were still getting issued, but they were paying very modest interest rates, still above sort of the central bank interest rates, but very modest compared to what you're seeing at the moment. So those bonds in today's market aren't worth as much, which means their valuations have fallen. People who invested in those will still get their money back upon maturity, but the sort of market price is lower. So that's something to bear in mind. You can see prices of bonds fall, although it doesn't happen very often. It usually only happens when you see interest rates rise very quickly. So bonds have been doing it pretty tough over the last few years as we've seen interest rates readjust from near zero levels right up to where they are today. And it's an interesting situation. We're seeing this all around the world, so it's not just here in New Zealand, but the US 10-year government bond yield pushed through 4.5% last week, and that was notable because that's the first time since the GFC, since before the GFC, that it's pushed through those levels. It's hasn't been that high since 2007. Start of this year, it was 3.9. End of July, it was sort of about the same, just under 4%. Today it's more than 4.5, actually approaching 4.6. So this 10-year bond in the US fell as low as 0.5% back in 2020. So you've seen a very big move higher. And here in New Zealand, it's been a similar story. We've got our 5-year swap rate, which is a market wholesale interest rate that's sitting at about 5.2%. That's the highest levels we've seen in 13 years, since about 2010. Ours hasn't moved up so much since the beginning of this year. It was at about 4.9 at the beginning of this year. Then it sort of came down, then it's gone back up again. So the moves haven't been as dramatic on a year-to-date basis. But that's an interest rate that was still almost at zero during 2020, during the pandemic. So the moves have been significant over the last few years, and we've seen those moves upward in interest rates continue, particularly over the last 2 months. Through August and September this month, we've seen those wholesale interest rates and those government bond yields around the world push higher. And that has led to weakness in asset prices across the board. So you've seen share markets lower, and you've seen bond prices lower because, like I just said, higher yields means lower prices. So let me just sort of segue off track just a little bit and talk about that, because we're at a really interesting point in the market. Then we'll sort of get back on track. But some of the reasons for those higher interest rates that we've seen over the last month or two are expectations for stronger for longer growth in places like the US, where you've seen good GDP numbers, good economic data, still low unemployment, even sort of industrial activity and so forth has been rebounding a little bit. So people are much more confident about the economy. The economy looks a lot more resilient. And what that means is people are expecting higher for longer interest rates. Can't have your cake and eat it too. If we've got a stronger economy that's holding its own, that means central banks will keep interest rates at high levels for longer, or even put them up more than we thought. And that is very much the rhetoric that people are thinking about and talking about at the moment. It's similar in New Zealand. We had that GDP data last week. Better than expected. So all the talk is, well, geez, the economy's not slowing as much as we thought. Maybe the Reserve Bank will hike another time. It all feeds into that same sort of thinking. I just want to push back on a couple of those things, because personally, I'm not convinced that we'll see another rate hike either from the Federal Reserve in the US, even though they're telling us that they will, and a lot of people believe them. I'm just not convinced. And same here in New Zealand. I'm not convinced that the Reserve Bank here in New Zealand will necessarily keep going. I wouldn't be at all surprised if both of them are done. And I've also got a feeling that both of those economies might soften a little bit more than people expect, the US and New Zealand. The GDP figures in New Zealand, old news. I think a lot's happened since then. And with China, with dairy prices, I think that will sort of feed through. And in the US, we might even see some more evidence just over the next couple of days. We've got some revisions to US GDP figures tonight, Thursday night. So we'll get them sort of when we wake up tomorrow morning, Friday. I wouldn't be surprised if those revisions are downward ones. If GDP figures from the past are actually revised lower. We've also got the PCE inflation report on Friday, and this is the Federal Reserve's favoured inflation measure. Look, it'll be a mixed bag, but I think when we look at those inflation figures just over the last, say, 3 months, and you sort of annualise the rate of change, I think that will also point to inflation moving in the right direction. Then you've got a government shutdown that's upon us, potentially, in the US. That could be a drag on the economy over the near term. We've got the latest US jobs report next week, and I recorded an episode a couple of weeks ago just talking about my view that there could be a few cracks starting to appear in the labour market. So I wouldn't be at all surprised if you just get a few of these things that are due over the next week or 10 days, starting with tonight. Just remind people that there is actually a bit more weakness out there than we think. And if that's the case, then maybe it just sort of does throw into question that sort of stronger for longer economic view and the higher for longer interest rate view. There's also the question about the US, what do you call it, excess savings, consumer savings, which have been were built up through the pandemic and have been run down over the last year or two. And a lot of talk and research out there at the moment that points to consumers actually having spent a lot of those excess savings. And this is interesting because this comes right on top of the beginning of the sort of retail spending season, the holiday season. So it's possible that you actually start to see consumers put the wallets away because they've spent a lot of those excess savings. I think the wealthy have still got some sort of savings put aside, but many people in that sort of low income and middle income zone have maybe gone close to expiring those. So I can't help but think there might be a few negative factors, which wouldn't be terrible, really, because it would at least remind people that maybe maybe you're not going to see the economy super strong and interest rates need to go particularly higher from where they are. But anyway, those are just a couple of things to watch out for. Anyway, because of all that, I sort of feel like we're at a tipping point. We've seen bond yields rise strongly. Bonds have had a tough time because of that. We've had all those headwinds. I feel like some of those headwinds might soon become tailwinds, and that would be a good thing. These high interest rates, the official cash rate, the highest since '08, wholesale interest rates, like I said, the highest since 2010. Bad news for highly indebted borrowers, but for conservative investors, if you're looking for steady income, that's not a bad backdrop. That means you're facing the best opportunities in a decade and a half. So remember that what's not great news for someone with a lot of debt who's a borrower is actually good news for all of those people that are looking for steady income. So it's not a bad time to be starting to think about bonds as an investment class, just in terms of where we're at in the cycle. And that's especially so if you believe that we're close to the point where central banks, like the Reserve Bank here in New Zealand, like the Federal Reserve in America, like all of them around the world, to be honest, if you believe that they're reaching the point where they've finished increasing interest rates, they've reached the top of the hill and they sort of plateau from that point. If you think we're near that point, then bonds look even better. Or if you think there's economic trouble ahead, if you've got a negative economic view looking out to 2024, if you think, geez, things are going to slow more than people realize, maybe there's recessionary risks out there, unemployment's going to go higher than people appreciate. If you've got a bit of a glass half empty viewpoint, then bonds look even better because those periods go hand in hand with lower interest rates. They often see central banks have to ease monetary policy to shore things up. A weaker economy helps inflation come down. We don't like weak economies, but they do provide more opportunity to get inflation under control because demand is lower. So if that's the way that you're sort of thinking, then you should definitely be sort of thinking about bonds at the moment. Impossible to say where the peak of interest rates is. Market interest rates, government bond yields, whether it's the US 10-year government bond, whether it's swap rates here in New Zealand. Impossible to say where the ultimate peak is. I don't know, to be honest. They could push a little bit higher, entirely possible, especially with some of the supply that's coming online with governments that have all got sort of higher deficits and they've got to borrow more. But what I do know is that typically interest rates, market interest rates, bond yields, reach their highs usually around the time of that last central bank hike. So if you're of the view that the Fed is done, the Reserve Bank is done, or even that there's one more in the tank, but just one, then you'd probably say we're sort of the top is probably somewhere around this point. And this is all important because I know a lot of people are favouring short-term bank deposits at the moment, and I don't blame you. High fives, maybe some of them even sort of knocking on the door of 6%. That's great value. So cash in the bank is giving you a great return right now, but you've got to sort of fast forward 12 months, 18 months, 24 months. And if you do that and think about where the economic backdrop will be, where inflation will be, where the economy will be, where unemployment will be, there's every chance that in 12 or 18 months, certainly 24 months, interest rates could well be lower than they are today, possibly quite a bit lower than today. So if you've just got that money sitting on the sort of 3 months, 6 months deposit and you're just rolling it over, at some point in the not too distant future, you are going to find yourself facing a much less attractive rate of reinvestment. So it's a great short term strategy, but it is a very short term strategy. So, in contrast, you can put together a portfolio of high quality fixed income, a range of bonds, and the maturities will be in that sort of 2 to 5 year range. And you can probably get a yield of, in the sixes, more than 6% from that. And that will give you, it will lock in some of that income at current rates. So, I think we should make hay while the sun is shining, take advantage of these higher interest rates, and just acknowledge that interest rates might not be this high forever. Over the short term, yep, they're going to stay high, but looking at 1 or 2 years, who knows? Things could change. So we've just got to make sure that we take advantage of that, and we might even get a bit of capital appreciation along the way if you see those market rates fall. So that's all I had to say. Hope that is useful. If anything in there sparks an idea or hits a nerve or makes you think, then touch base with an investment advisor, one of ours if you want the best, someone else's if you don't. But talk to someone and get some good advice, because there are opportunities in the current environment. All right. Thanks for listening. Talk again soon.